Okay, let's start. Good afternoon to everyone. This is Nicolas speaking. I'm Senior Account Manager in Ford Trade Brokerage Company. I will lead you tonight, actually this afternoon, during the today's webinar. The main topic of the webinar is Federal Reserve interest rate decision and potential influence on traders and market. The topic is very actual and relevant for all traders with different kind of assets, and also it is one of the most important events that will take place in this month. Actually, it will take place on Wednesday evening, but it is something that will make one of the deepest leads in the charts and in financial markets and also in the global economy. In the beginning, I would like to remind all attendees about risks that you are undertaking while you are trading with CFDs. The CFDs are leverage products that are carrying the high level of risk. And all CFDs are actually based and underlined on some kind of assets that is tradable on the financial markets, and we have to be very careful since we are speaking about margin tradings. As long as it is a very good opportunity for trading and making a potential profit, it's also risky, and your capital can suffer from losses in future or in tradings. The main topics in this webinar will be actually current situation. We'll discuss a little bit about current economical situation in the United States, and also we'll speak about some macroeconomical measures that are directly connected to monetary policy of Federal Reserves. It has the measures that Federal Reserve officials are taking in consideration when they are discussing and deciding to increase interest rate or to remain with current interest rate. Again, after that, we'll speak about facts that are pro and contra interest rate increase decision on the Federal Reserves. Also, we'll mention some previous market reactions on these kind of decisions in history, and we'll speak a little bit about technical analysis of a few instruments that are, let's say, most attractive to all traders and that could possibly take place in or during announcement of decision of Federal Reserves on Wednesday evening, and after that, in the days and weeks after that. When we're speaking about current situation, first of all, we have to define the scope of macroeconomical measures that Federal Reserves are taking in consideration while they are making the monetary policy. The things that are connected to main goal of Federal Reserves are mostly followed up by the economists and analysts when they are making interest rate decision. I have to remind the attendees that main goal of Federal Reserves, as the majority of the national banks in the world, is to hold prices under control and to obtain a long-term price stability for the economy. This is the main goal of majority of national banks in the world, and so on. It is the same situation with the Federal Reserves. The economical theory says that the prices in general are connected to employment, and from one side employment, and from the other side this is a tightly connection with inflation. So the interest rate is a tool how to hold under control prices in the long term. Now, if more people are employed, more people will be able to spend their money, and on that way they can influence on aggregate demand on goods market, and with this impact, the prices can go higher or lower. If they go higher, we have inflation. If prices are going lower, we have deflation. Positive inflation, slight positive inflation, is something that every um, every national bank, every economy consider as a positive impact on uh, uh, economy in general. The slight positive inflation have positive impact on the gross domestic product, and sometimes some analysts and uh, economists are saying that inflation rate of 2% should generate economical growth of 4%. Now, the target inflation rate of Federal Reserves is 2%, and we'll discuss about some different kind of inflation that can be measured and that analysts and Fed officials are using when they are following up the inflation rate and the dynamics of that movement. So we can distinguish the inflation that is basically a product of some different impacts that are external. For example, price of crude oil has the highest impact on the prices on markets of goods, and this is not something which is actually derived from aggregate demand. That's why we have the different types of inflation that are trying to exclude these impacts that are so-called external um, in domestic economy. Of course, sometimes when the economy is not so well developed, like the economy of United States is, the external factor could be also the exchange rate that is also influencing on the inflation. But this is something which is out of our focus right now. We are speaking only about the United States, and currently the core PCE stands on 1.4%. PCE is one specified measure of inflation that is actually following up the personal consumption expenditure. This is like a personal consumption expenditure index, and this is something that excludes food and energy. Actually, it's trying to exclude the influence of volatility of food and energy on the prices of other goods that are under general spending lists in a spending basket of every individual. So this is like figure 1.5. It's below the Fed's target, but other measures that are, for example, CPI, Consumer Price Index, or core Consumer Price Index, are around 2%. Now, it's the question which one of these three Federal Reserve will point as the most important result in during their discussion about interest rate decision. Let's go one step backwards. Something which is actually causing this inflation. This is, as we said, personal spending and individual demand and aggregate demand on goods market, and this is something which is derived from employment. In the beginning of the month, we got very bad result regarding non-farm payrolls. The Federal Statistical Bureau for Labor Force reported 138,000 new jobs in private sector opened in the previous month, which were lower than expected. But we can say that average in last 3 months or last 6 months was around expected 200K a month, which is a wish of Federal Reserve to see as a positive, trend on labor market. From the other side, we got unemployment rate 4.3%, which was better than expected. Now the difference between these two results, one was lower than expected and one was better than expected. The difference is in statistics, because when you are looking on the employment rate counts only people that are actively seeking for the job. Now, if we had one out of two people that got the job in previous month, and the second one gave up from seeking of the job because they have, let's say, common life, they are living together, etc., and they consider the income of one person that is enough for their together spending. So the count of unemployed people changed for two. Never mind if one got the job, second one gave up from the active seeking from the job. That's why we got different trend in these two results. Now, let's say 3 years or 4 years or earlier in history, Federal Reserves were following up the unemployment rate as a measure that is very important for them in their monetary policy. But when they decided to go deepen in labor market analysis, they saw those differences and they introduced a couple of different reports that they're following on a monthly or quarterly basis. One of them is NFP, that is publishing every first Friday in a month, and it's also followed by the another one, a result called ADP. We discussed it last week, if you remember. Now, the results are not so bright, but they are also not so bad. The difficulty for the traders is derived just from these uncertainties about reports. Now, if we are looking in the history, we'll see that some positive trends shown in each one of these four measures that we are looking up, and they are counted on the screen. Just the one that we didn't discuss is GDP. That was better than expected. It is for the first quarter 1.2%. Just to remind you, the preliminary result was 0.7%. The second release was expected to be 0.9. It came 1.2. So it was much better than expected and preliminary stated. And it shows that it's not so dark situation within U.S. economy, and that gives, let's say, the strong signal that Federal Reserve might continue with their pace of interest rate increasing. Currently, traders see more than 90% chance that Federal Reserves will increase interest rate on their next meeting, which will take place tomorrow and on Wednesday evening. Now, additional factors that may have influence on this decision are connected to political situation in the United States, and also the impact on the market depends on this decision can be the different. Now, also the stocks of financial institutions, mainly the banks, began to give back some to their post-election gains. So the current situation is, let's say, prevailed with some kind of uncertainties, but still there are very, very clear situation about macroeconomical data that we can see in economic calendar. Chart, we can see the dynamics of interest rate increasing process by the Federal Reserves. Now, in this chart is shown the U.S. target federal funds rate. Now, I have just to explain a couple of things. In each central bank have two possibilities to publish its interest rate. One one option is to put the benchmark interest rate, which is like a median between upper interest rate, which is interest rate on loan facilities, and the lower interest rate, or so-called passive interest rate, which is interest rate on deposits. In United States, they are not publishing the benchmark interest rate; they are publishing the range. Now, in 2015, actually until the December of 2015, the interest rate in the United States was 0 to 0.25 percent, which means that interest rate on deposits was 0 and interest rate on loan facilities was 0.25. Now, the difference between these two types of active and passive interest rates are 0.25 percentage points or 25 basic points. And usually Federal Reserves are taking the actually 1/4 of percentage points increase step. So each time when they're increasing interest rates, they're increasing by 1/4 of percentage points or 0.25 percentage points. Now, in December, we had first time after almost 10 years of lowering interest rates in the United States, they increase it from a range of 0 to 0.25 to next stage 0.25 to 0.5%. The second increase take place in the end of 2016. There was also a lot of disappointments during the 2016 market expect, as they was previously announced, two increases of interest rate, but market got only one. Now, in December of 2016, they said that they are planning 3 times to increase interest rate in 2017 until 1.5%. Now, they made the first step in March this year, and after that there was a lot of discussions about further pace and further dynamics of interest rate increasing. And currently, according to the analysts and according to polls, most probably this Wednesday they will increase interest rate for the second time during this year and the third time within last 12 months. So it is expected, and you can see the expectation on the economic calendar, that on Wednesday evening, Federal Reserve is expected to rise interest rate to 1.25%. Now, in this chart, you can see the probability. You see the range 100 to 125 basic points, which corresponds to the range 1 to 1.25% that interest rate will be on next meeting that will be held on 13 and 14 June 2017. Also, we can say that in last 1 month, usually the probability that Federal Reserves will increase interest rate on the next meeting, what majority of the time it was above 60%. This is according to Federal Funds Outlook, and some financial institutions such as Bank of America and JP Morgan, they also were giving their projections and their probabilities regarding this issue, and most of the time it was expectation that the probability for this interest rate increase is above 90%. So outlook is very, very positive. Now let's take a look on pros and cons for interest rate decision in United States. Now, Federal Reserves have previously indicated that there will be 2 more hikes in 2017. This was stated after they increased interest rate in March, and many FOMC members confirmed this statement. Also, some of them gave some speculative statements that there might be also more than 2 interest rate hikes during 2017, but this was not confirmed from all officials, and the source cannot be counted as relevant. Jobs figure probably are not going to look any better this summer. So this is something that we discussed for so many months. Let's say last 2 or 3 years, usually the NFP is around 200,000 a month, sometimes even more than 200,000 per month. And usually within the summer working season, there is a lot of seasonal jobs that are created in the labor market. So usually the summer months are giving better and better figures. But let's say in last 2 or 3 years, we can say that average monthly addition of new jobs was around 200,000. We cannot bargain the fact that U.S. labor market is tightening. Now, this is something that is, let's say, in the middle of focus of Federal Reserve, because they don't want to discourage investors to employ more people, and also they don't want to discourage employed people and people with money to spend that money if they increase interest rates. So that's why there is a so big discussion about this issue, and Federal Reserves, they don't want to take step forward until they are sure as much as possible that this will not have negative impact on two main macroeconomic measures that they are interested in: price stability and full employment. Also, which is very important, that extremely low monetary policy rate is creating a bubble on stock market, and this is something that has to be stopped if they don't want to see another deep financial crisis, which was the case in 2018 also. So extreme low interest rate is just giving a chance to the banks and speculators that are pumping up the prices on financial markets, and not to stream money in real economy, in production, and in employment. So this is something that has to be stopped in order to secure sustainable and long-term developing path from the economy that is trying to recover from very deep consequences that left the previous crisis. Counterfacts for interest rate increase decision is disappointing NFP results in the previous month. Actually, the results that we got just in June. Also, we can count the falling of unemployment rate to 4.3% as a wrong reason for a falling of unemployment rate. As just stated before, there might be statistical error because unemployment rate is just counting the number of people that are actively looking for the job. If someone is not looking for the job actively, he's still unemployed, but he's not counted in unemployment rate. And this is something that actually make the picture of labor market a little bit blurred. Now, what is also very important is that another measure that is introduced to be a marginal measure that Federal Reserves are following up is wage growth. In last 12 months, since Federal Reserves increased interest rates 2 times, in the meantime, the wage growth stop to accelerating. This is something that we'll show in the next chart, just to say about inflation. The core PCE index is missing Federal Reserve's 2% target. So this is also again the fact that is saying in contra for interest rate decision. On this chart, you can see average hourly earnings, which is actually wage growth in last 10 years since 2007, and we can see that it started to improve in 2012. In the 2011, it started to stabilize from the previous downtrend, and in 2011, in the end of 2011, it started to improve a little bit and start to make some positive trend in 2013 and 2014. This is something that starts to actually make some kind of saturation, and since Federal Reserve start to increase interest rate, it start to fall down or to stabilize on some level, which actually is not showing any further progress. This is something that also is concerning a lot of economists, analysts, and also Federal Reserve officials. So please remember this chart when we are speaking about a further interest rates decision, and when we are speaking about some results from labor market in United States. Also, the core PCE index on the annual level is showing some kind of positive trend. You see, for example, since it touched the bottom in 2011, it was below 1% or an edge with 1%. The bottoms are higher and higher, but still it's missing the 2% that is target to the Federal Reserves all the time. It was breached just once in 2011, in 2012, but still it is below target that is given by Federal Reserves. Also, the PCE, as I said, it's measuring the price change. It's index of prices, but the volatility caused by changes in price of food and energy is excluded. So here we have pure inflation based on individual expenditures, individual consumption expenditure or personal consumption expenditures. Now, the market reaction to the previous Fed interest rate hikes is a little bit different. Usually, dollar was getting stronger and stronger, since when you have higher interest rate, majority of the people that are saving money intend to save in the currency that provide higher interest rate. But at the last meeting, when interest rate was increased in March 15, the market reacted in that way. The dollar index fell in generally 1.47%. Gold futures jumped 2.5%. S&P 500 index of 500 most liquid shares in United States rose by 1.05%, and Euro USD currency pair increased 1.8%. This was the reason, actually the consequence of the fact that expectation that interest rate will be increased were already priced in dollars. So actually in that moment, traders just take the profits and went out from the positions. Now, the difference between this and previous Fed meeting is that this meeting will be followed up by economical projections, and also it will be followed up by press conference of chairwoman of Federal Reserve, Janet Yellen, some half hour after interest rate decision. So the timetable is like following. On Wednesday evening at 7 p.m. UK time, Federal Reserve will announce their decision about interest rate. Expectation that they will increase interest rate by 0.25 percentage points to 1.25%. In the same moment, at 7 p.m., they will release the statement and economical projections, and at 7:30, Janet Yellen is holding a press conference regarding that. So from this press conference, actually the traders are expecting the most, whether she will give some signals for the further interest rate decisions in the next month or in the autumn, and some comments regarding the economical outlook after they increase interest rate, or while they are remaining the interest rates the same. Now I will present you a couple of materials that our research department prepare for our traders. They see a couple of opportunities in euro dollar and GBP dollar, and also on gold, based on some facts that are actually trying to support their expectations. So according to our research department, the intraday and weekly trend on euro dollar is downtrend as long as price is below 1.15 in the short term, which is intraday, and as long as price is below 1.76 on the weekly basis, with support 1.1154 in intraday and 1.1159 in weekly level. On the contrary, monthly level, it is expected that price of euro dollar can go up. Support level is 1.0952 and resistant level 1 is 1.1383. Critical point for the entering in position is 1.11847. Now in here you can see the calculation in the intraday. The calculation is based on the one lot trading and the difference between critical point and resistant and support line, calculated in three currencies: dollar, euro, and the British pound. Also, the same thing is with the British pound. According to our research department, there is also some political events that are important for the UK after the elections that are finished last week, and considering also the potential federal interest rate decision of this week. Our analysts from research department, they see intraday and weekly trend on the Brit pound American dollar currency pair downtrend, as long as price is below 1.2693 in the intraday and 1.2891 on weekly level, with support 1.2625 in the intraday and 1.2548 on the weekly level. The same thing like with euro dollar, and contrary to the previous two time frames, the monthly level, they expect that British pound can gain some profit against dollar, actually to benefit from these political processes of Brexit and assembling new government, and to increase its value against dollar with a resistant 1.2937 and support 1.2524. Critical point for entering in position is 1.2659, and calculation for intraday is on the second table. And the last market opportunity trading idea is on gold. Orientation is pretty much the same. Our analysts see the intraday and weekly trends for sell, actually downtrend. The critical point for entering in position is $1,264 per ounce, and resistant one is intraday level 1,270, and weekly level 1,288, with support lines. Support line 1 in intraday 1257.68 and 1256.58 in the weekly level. Unlikely this to the monthly level is uptrend with support line 1229.54 and with resistance line 1301.57. Also, you here have some calculations. All calculations are based on one lot trading, which is on currency pairs 100,000 units of base currency in the currency pair, and on gold it is 100 ounce of gold. Now there is a time for questions. If there is any question regarding the topic that we cover in this webinar, you can ask now. One attendee just asked about the timetable. I will repeat it, please. Usually, there is, not usually, actually, the Fed meeting is taking place 8 times a year. They have 2 days meeting. It is in the middle of the week, Tuesday and Wednesday. Every second meeting they have press conference, and in this case the Fed interest rate decision will be announced on Wednesday 7 p.m. UK time. In the same time will be published the FOMC statement and economical projections, and at 7:30 p.m. Janet Yellen will hold a press conference, so there will be a lot of information in that period. The Fred asked how long will be the impact last on the market, a day, couple of days. Well, actually depends mostly depends on the press conference content, because usually previously the speeches of FOMC officials had also the big impact on the market. Usually market is taking some direction next, let's say, month or two based on the previous interest rate decision or announcing, but the short-term volatility can be very, very high. So it depends on which kind of volatility you are interested in. If you speak about something which is the short term, usually it takes place, let's say, one day market is reacting upon results, the following day there is a correction if someone is going out from the positions, taking a profit, etc., etc. But the general trend and general orientation is taking impact, let's say, another month or almost 2, depends whether they are giving some long-term hints for the future. If there is no other questions, I would thank to the audience. I will remind all of you that you can apply for a recording of the webinar, so you can follow up the explanations also in the next days. Be updated. Also on our website you can follow up the daily analysis. The analysts are following up the news day by day, and after that you can follow also the results that will be published on the economic calendar on Wednesday evening. Thanks a lot for the attention. I wish you successful tradings and good luck. Bye bye.